Go to Unit 6, which talks about the valuation methods and cost of capital. Now, we have defined under our discussion of capital structure the fact that organizations can use their own money or other people's money to fund business. By the time you use other people's money, it is called a debt, because you are not only paying back the principal amount, but you also have to pay for the cost of that capital, which in essence are determined by the interest rate that awaits such a borrower. Therefore, the component of cost of capital have all the sources of fundings that are available to the organization in the same component that make up this capital structure. Either you have a preference, a debt, which is usually calculated on after tax basis, or you have also the cost of preference stock, which is usually use a dividend yield decision methodology, whereby you divide the cash dividend on a preference stock by the market price of the preference stock itself. Or you also have the cost of a common stock, which usually use the dividend yield ratio, whereby the cash dividends on common stock are divided by the price or market price of the common stock itself. So these three components actually gives you, irrespective of the organization, the kind of capital structure that organization faces at any point in time. And sometimes you will also be asked, what should be the cost of retained earnings? What about the company is using their own internal money, but that internal money is coming from the retained earnings account? Analysts believe that the most appropriate measure for that kind of cost or that kind of cost of capital should be equivalent to the cost of a common stock. An exercise. Here we are told that a company issue 100 million 15% debenture of 100 naira each. The company is in a tax bracket of 40%, and you are asked to calculate the cost of debt. And from the cost of debt, which is the cost of borrowing external fund, we say the cost of debt is equals to the amount you have borrowed 1 minus the tax rate, which defines, that is, the fixed interest rate you have on the capital 1 minus the tax rate. And therefore, for this, we will have a cost. We are told that this is a 15% investment opportunity, 1 minus the tax rate that the organization faces, which is 40%, 0.4. And here we are 15% times 0.6. That would be the cost of a debt. And the cost of debt always have that discounting because they have the benefit of being tax deductible. If you are given a cost of debt and a cost of equity at the same level of 15%, the presumption is always that the cost of debt is always cheaper because they are tax deductible. And we can see the impact of that tax deductible. In the first value of it, a person looking at this cost of capital is, okay, it is 15%. So if I am giving, for instance, an equity at the same 15%, you may be likely to say, okay, let me go for equity because equity means we own the money. But it is not. The tax or debt also have an advantage. And the advantage is it is deductible from tax. So the actual cost of capital will be the cost of capital you have on the face value of the debt minus the tax rate that the organization will enjoy from such debts. The next one would be the cost of preference shares. And the cost of preferred stock, which we have also identified as one of the sources of financing that organization faces, is defined by the dividend that the investors of this cost normally enjoy. And we said that the cost of preferred stock is simply the dividend that the organization, the dividend per share all over the market price of that stock minus flotation cost, if there is any at all. If there is any flotation cost, you now have to discount that. For example, we are given that a company issued 10% preference stock of face value of 100 naira each. Flotation costs are estimated at 5% of the expected market price. What they are asking now will be the cost of this capital. And the cost of capital is always the dividend that organization will have, and dividend from this question mean the dividend per share will be equals to 100 naira times the percentage that is attached to it, which is 10%, which therefore means the dividend from this per share is 10 naira. Yeah, and then we are given the market price of the shares and also the flotation cost, which will be the 5% of it, and the 5% of 100 will give us 5 naira, which will be the flotation cost. So, in substituting this into the formula we are given, we simply say our dividend is 10 all over the 100 minus the 5, which gives us 10 all over 95. So this is the cost of the preferred stock for the firm. Then the last one will be the cost of common stock. Common stock are assumed that if you purchase a common stock, you are purchasing ownership into the organization. So you don't enjoy the benefits that a debt holder actually enjoy. A debt holder actually are superior claimants when you get to liquidation side of the business, and they will always be paid before any other ordinary share or common stock get paid. A preference shareholder will also likely to be paid before a common stock holder, and therefore the common stock holder from the finance point of view are usually defined as the residual claimant. You are the last guy in the line of being paid if the company has to go down. It therefore means if at that time when the debtors are settled and also the preferred stock are settled and also other obligations that are not related to equity have to be settled, whatever that the organization have left, that is what the common stock holders get. If there's nothing left, they go on with nothing. An example, the cost of equity therefore for a common stock holders, looking at this example we are giving, that a company's share traded at 60 naira per share, if the company pays a dividend of 3 naira per share, an investor expected a growth rate of 10% per share, we should calculate the cost of capital. Now, before we go into this exercise, I will need to explain two different things. One, there is a methodology or a model for calculating the cost of a common stock when you have a stable growth and infinity growth steadily. And then you also have what the cost of capital is likely going to be using another model by the time you start having a step changes in the earnings, in the growth rate of this dividend over time. But for the purpose of this class, we will not go into the step changes, but we will assume a normal growth rate that is constant over time to calculate our common stock. And we were given that a company has a traded stock here of 60 naira. If the company pays a dividend of 3 naira per share and the investor is expected a growth rate of 10% per year, we should calculate what the cost of capital is. For a cost of capital for a steady growth is equals to the cost of capital, your dividend per share, divided by the price, the market price of that share, plus what the growth rate that is being expected. In this question, we are given that the company is expecting a dividend of 3 naira per share, divided by the price, the market price is 60, plus what the growth rate is. And the growth rate we are told is 10%, which is just 0.10. And this will give you whatever the cost of capital or cost of equity will be for this particular firm. Now the next part is for analysis driven Organization will not have a cost of capital in isolation, and therefore in corporate finance, what you normally have is a weighted average cost of capital, because what you see in most institutions are such that they actually leverage on different sources of funding. They can also borrow some of them. They can raise some funding through equity. They can also raise some funds through debt and also through preference shares, or actually call on the retained earnings to be able to fund some projects. It therefore means that one single sources of funding may not be sufficient to run organization investment opportunities or finance investment opportunity real time. So therefore, what you need to define at any point in time should be a weighted average cost of capital, looking at the firm capital structure as a composite, that you have a source of some of your businesses are or projects are funded using equity, or some also are funded using combination of equity and preference shares, and some are also funded by debt or combination of equity, preference share, and debt. This actually creates now a composite, a different multi-layer sources of funding. And there is the last layer also, which is what I said, return earnings. Maybe from your profit that you have actually saved for rainy days, you can also call on it to fund your project. So the combination of all these four sources now form a capital structure. Now, the question is, what will be the single digit cost of capital that is optimal for organization? Analysts believe that the most effective way of determining that single composite value that will be reflective is to calculate the weighted average of each of these costs and combine that weighted to get a single composite of a value that determine which of the sources of funding actually provide organization with a more better way of managing their capital or achieving an optimal capital structure. And this last exercise actually did emphasize that, which based on the exercises we have treated, what you need to do is to provide a table that allows you to calculate the weighted average cost of capital. And in weighted average cost of capital, each of the capital sources must be weighted along the side of their value. And then you arrive at a weighted average by combining those two sources of funding. That gives us what the weighted average cost of capital will be. Then this takes us to the next unit, which is Unit 7. Unit 7 talks about the short-term financing. And why we need to talk about short-term financing is the fact that over time we have learned that most of businesses are actually financed by short-term instruments. Short-term instruments have become one of the largest but not formal sources of funding for businesses. Organizations nowadays actually rely on spontaneous sources of financing like trade credit or account payables to finance their businesses, or short-term commercial banking or marketable instrument as the case may be. So short-term financing is ideal, it's a big deal when you get to the corporate finance, because it provides the largest and the most patronized sources of financing business opportunities for a short-term period. What do we mean by spontaneous sources of financing? Spontaneous sources of financing actually is a way of deriving or raising funds or actually financing your business without out-of-pocket expenditure. For instance, a small businesses will approach a supplier to supply and pay at a later date, or approach a supplier, make some down payment, some part down payment, and expect that the full payment or the balance of the payment will be made in subsequent time, and based on the credit time that are usually agreed by the supplier. And you have a credit time that ranges from 30 days to 60 days to 90 days, 180, all depends on the disposition or the credit policy of the organization supplying such credit. And why we need to learn about short-term sources of funding is the fact that small businesses always leverage on these sources of funding. Now, one of the things to also note in the spontaneous sources of financing or short-term sources of financing is the fact that you will be given a credit that allows you to pay some amount of money immediate and also pay off the balance later. At any point in time you pay for the cash, whatever that is left that you are going to pay in a later date, create an account which we call an account payable. But if you are the one that is selling on credit, the moment you sell on credit and some little amount were paid using cash, while the balance were expected to be paid at the future date, that actually create an account receivable for you, because this amount you are expecting at a future date. Now, from the finance point of view, at what point should you take the discount, or we shouldn't actually take a discount based on a credit purchase? Now, in order to, when you should take a discount, it should be at a point where the usable fund, that is the term credit or usable fund, and the invoice amount became incentivized, that provides you with a lot of savings that you couldn't have got if you have approached other sources of financing or using other methods within the short-term financing. Now, if at any point in time when you are giving a trade discount, the rule of thumb is that you should take such credit discount, because there is an incentive in taking a credit discount. Mathematically, you can also be able to calculate the cost of not taking a discount when you are giving. Now, in most cases, credit terms are usually defined in a way that are mathematical, but they are also explainable. Now, a typical credit term can reach 5/15 net 30, meaning that you are entitled to a 5% discount on the credit that you are owing if you can pay within 15 days. If otherwise, the total amount that you are owing will be due and you will have to pay in 30 days. In other words, what are we saying? If you purchase an item on credit for 10,000 and you only pay 10% of it, which is 1,000, it therefore means that you promise to pay the 9,000 at a later date, which create an account payable for the organization or for the supplier. Then supplier will also need, sometimes gives you incentive for this credit. An incentive may be on this term that shows that you can pay me the 9,000 within 15 days, then I will give you a 5% discount on this 9,000. Meaning that if you have to take the 5% discount, it therefore means that this guy is giving you about 450 naira, because 10%, 5% of this will give you 450. So whatever you are going to pay back will be 8,450, which gives us the total of the 9,000. This therefore means that a 5% discount you will be entitled to will now make you pay within 15 days. If you have to pay within 15 days, this is the amount you pay them. The amount you pay will be 8,450. But if you do not meet up with this and the window of the discount expire, anytime you pay after the 15 days, you have to pay the full amount that you are owing, which is 9,000, and it must be within the 30 days grace period. We have an exercise that we'll look at to determine at what point should you take a discount and at what point should you ignore it, a discount. Then the next slide, we talk about the short-term bank loans. We have two types. The term loans, the line of credit, and terms loan are usually a short-term source of financing that a bank normally gives and which are payable within an agreed date, and also the interest that each of these term loan will bear and the condition guiding those term loans. Then you also have another facility called the line of credit, which is a revolving credit facility. Most cases these days you can have from your bank being given a credit card whereby you have some predetermined amount that is on that credit card, and what you do is to use that credit card any point in time you want to use it, and then the organization or the bank charges you some specific part of interest on the amount that you actually spend or on the amount that you didn't spend, depending on the mechanism that is guarding that particular interest rate. Another part of the effective interest rate in loan is to determine what is the exact rate that you are charged on a loan. And in every time you have a loan, you have to determine, you have to be very specific in your analysis, how much will this loan cost, and the loan are usually cost based on the interest rate that they are actually bearing. An effective interest rate on loan usually is the net interest rate. If, for instance, you actually took a loan of 10,000 and at 5% interest, the interest on this per annum means that you are going to pay 500 as an interest per every year that you owed this loan up to the time that the loan will expire. Then there are some loans that are with discount. Discount means that if at the time of disbursement, for instance, the loan you took of 10,000 on discount, the bank will actually credit your account by the time they finish processing the loan by removing the loan interest upfront. It therefore means that if you take a loan that are discounting based, for instance 5%, which we calculated as 500 naira as your interest per annum, what you will get credited from the bank on that loan will be 9,500, meaning that they have taken their interest upfront, and therefore usable amount that you will have from your loan will be 9,500 as against the 10,500, the 10,000 naira loan you have taken. And there are some loans that we call a compensating balance loan. Instead of charging you an high interest, banks sometimes will subject you to compensating balance. Compensating balance meaning that you have to maintain some level of minimum balance in your account. They may give you a loan of 10,000 and they will say, okay, instead of charging you 5% interest, we are going to be charging you 3% interest, provided that at any point in time during the duration of loan, your balance, account balance with us must not go below 5,000 naira at any point. So this actually provides the incentive for the banks to also use the amount that is standing on your balance to actually trade or lend the money as a credit facility to other prospective investors, and thereby getting the difference between what the prevailing rate is and what they actually have charged you from their own loan to back up and also to match with their competitive bidding. Then we have an exercise here that talks about the credit terms. A firm is given a terms of 2/10 net 45 by its suppliers if the firm forgo the cash discount and instead pays the supplier on the net due date. What is the annual interest rate cost using 365 days per year? Now, if you are giving an interest, the cost for you of not taking this discount will be defined by it will be defined on the basis of how well you are able to hold on to that amount that you should have paid the creditors that you are holding. If you can be able to revolve it around and make up for the discount that you didn't take. And we said from the previous exercise, the cost of not taking discount is your discount all over 1 minus the discount rate times the number of days in a year all over the total credit date minus the discount period. In this case, we are given that you are entitled to 0.02 discount 1 minus 0.02 times 365 days all over the 45 days that you need to pay minus the discount period that you have of 10 days before you can enjoy the 2% discount. And by the time you look at this, this will gives you 0.02 all over 0.98 times 360 divided by 35. And this actually allows you to calculate what your effective rate is. Whatever you get as your effective rate from this, you compare that with the cost that an alternative cost that you will have used those finance for 10 days. If that will be able to make up the cost that you are foregoing here, then it becomes lucrative for you to take the loan, to take the interest, to take the discount. If otherwise, you can actually forgo the discount. And that with this, I think we come to the end of this model. And just to remind you that in corporate finance, the fundamental in every analysis is guided by the need to recognize the time value of money and the risk element that are usually embedded in investment decision. Thank you very much.